Today, we will talk about the dividend discount model, DDM. The dividend discount model is a quantitative method used for predicting the price of a company's stock based on the theory that its present-day price is worth the sum of all of its future dividend payments when discounted back to their present value. The goal of this model is to calculate the fair value of a stock, irrespective of current market conditions. The DDM model is based on the theory that the value of a company is the present worth of the sum of all of its future dividend payments. This means that the business profits determine the stock prices, and the expected dividends are an essential factor in valuing the stock. The time value of money is a fundamental concept that states money's value is dependent on time. This means that if you know the future value of an asset or receivable, you can calculate its present worth using an interest rate model. The DDM takes the expected value of the cash flows a company will generate in the future and calculates its net present value. Estimating the future dividends of a company can be complex. Analysts and investors may make assumptions based on trends in dividend payment history. The future dividends can be calculated based on a fixed growth rate or by identifying trends in past dividend payments. The discounting factor in the DDM represents the compensation that shareholders expect for bearing the risk of owning the stock. This rate of return can be estimated using various models, and it is dependent on the company's dividend growth rate. The formula for valuing a stock using the dividend discount model is based on the expected dividend per share and the net discounting factor. It allows the calculation of the fair value of a stock based on the expected future dividends and the cost of equity. The DDM has many variations that differ in complexity. One common variation is the Gordon growth model, which assumes a stable dividend growth rate in perpetuity. Another model considers a period of high growth followed by a lower, constant growth period. Examples of the DDM include calculating the price per share for a company based on its current dividend and expected growth rate. The DDM can be used to value stocks and identify buying or selling opportunities based on the calculated fair value. The DDM has shortcomings, including assumptions of constant dividend growth rates and sensitivity to inputs. It may not be suitable for newer companies or those with fluctuating dividend growth rates. The model's precision decreases with increased assumptions. The DDM can be used for valuing shares and making comparisons among companies, even across different sectors. It can help identify overbought or oversold stocks, but it should be used in addition to other stock valuation methods and not as the sole basis for investment decisions. The main types of dividend discount models include the Gordon growth model, the two-stage model, the three-stage model, and the H model. Here are three key takeaways. 1. The dividend discount model, DDM, is based on the theory that a stock's present price is worth the sum of all its future dividends when discounted back to its present value. 2. The DDM allows for the calculation of the fair value of a stock, irrespective of current market conditions. 3. Investors can use the DDM to identify buying or selling opportunities based on the calculated fair value of a stock. Hope this would help. Thanks for watching.